You just paid off your car loan 3 years early. You feel lighter, free, like you beat the system. Your bank sends you a congratulatory letter. They close the account. You frame the final statement. What they don't tell you in that letter is this: they just made more money off you than if you'd stretched that loan to the bitter end. And it's not a trick. It's not a scam. It's just math. Math you were never supposed to notice. Most people think paying off debt early is a financial win, and in some ways it is. You stop paying interest, you own the thing, you sleep better. But here's what almost no one understands. The profit model of a bank doesn't care whether you pay them over 5 years or 15. What they care about is something called the time value of money. And when you pay early, you hand them a gift they didn't even ask for. Let me show you how. Imagine you take out a $30,000 car loan at 6% interest over 5 years. Your monthly payment is around $580. Over the life of that loan, you'll pay about $4,800 in interest. Now let's say 2 years in, you get a bonus. You pay off the remaining balance in one lump sum. You just saved yourself 3 years of payments. You saved around $2,900 in interest. Congratulations! But the bank, they just won. Here's why. When you took out that loan, the bank didn't just lend you $30,000 and wait 5 years to get it back. They created that $30,000 out of thin air through a process called fractional reserve lending. They're required to hold only a fraction of the deposits they take in, let's say 10%. The rest they lend out to you, to everyone. So when you borrow $30,000, the bank might only need $3,000 in actual reserves to back it. The other $27,000 is essentially new money, created the moment you sign the contract. Now, here's the key. That money only exists as long as the debt exists. When you pay the loan back, the money disappears. It gets deleted from the system. The bank keeps the interest, the principal vanishes. But early repayment does something else. It gives the bank cash, real, liquid, deployable cash, right now, not in 3 years, now. And cash today is worth more than cash tomorrow, always, because the bank can immediately turn around and lend that money to someone else at 6% or 7% or 12%, depending on the product. They don't have to wait. They can compound faster. You thought you were cutting them off early. You were actually accelerating their returns. There's a reason credit card companies and auto lenders don't fight you when you pay off a balance ahead of schedule. They're not heartbroken. They're not sleeping late. In fact, some of the largest banks in the world have entire departments dedicated to modeling prepayment behavior. They run Monte Carlo simulations to predict how many borrowers will pay early. They price that risk or opportunity into their loan products from day one. Your early payoff, it was in the spreadsheet before you even applied. And here's the darker layer. Loans that get paid off early are often replaced by new loans. Maybe not by you, but statistically by someone like you. Because here's the uncomfortable truth. The financial system doesn't benefit from people being debt-free. It benefits from a constant rotating pool of borrowers, all paying interest, all creating money, all feeding the machine. You paid off your car, good for you, but someone else just financed theirs, and the cycle continues. The bank doesn't need you to stay in debt, it just needs someone to be. Now, zoom out. This isn't just about car loans. It's about mortgages, student loans, business credit, sovereign debt. It's about a system where money itself is mostly debt, where over 90% of the dollars in circulation were created by banks issuing loans, not by governments printing bills. And in that system, paying off debt early doesn't break the cycle. It just speeds up the next round. The bank gets liquidity, they redeploy it, they grow their balance sheet, they report higher returns, their stock price goes up, executives get bonuses, and you get a congratulations letter and a closed account. You're out. But the game continues, because the game was never designed for you to win by leaving. It was designed for you to win by playing, over and over and over. So, was paying off that loan early a good decision? Honestly, maybe. You're not paying interest anymore. That's real. That's yours. But if you think the bank lost, you're mistaken. They didn't lose, they just won faster. And the most unsettling part, they didn't hide this from you. It's not a secret. It's just structure, incentives, math. The kind of math that works whether you understand it or not. So, here's the question you should be asking. If paying off debt early still profits the bank, what would actually take to beat them? Think about that. And maybe, just maybe, you'll realize the answer isn't about paying faster. It's about understanding the game you're playing in the first place.